Morning, everyone. Thank you so much. It's an honor to be here with this fine group. I've been coming for a while, and it's just really an honor. I know I've spoken with several of you. So hopefully by the end of the day, you have a little bit better, end of this morning, have a little bit better idea on what I try to do and how I try to work with financial advisors, elder law attorneys, estate planners, CPAs, and try to leverage the $14 trillion of equity that's sitting in baby boomers' houses right now. A lot of people, I work with people who have what I call it, it's not derogatory on either end. I work with those who have a need, and I work simply with those who have a greed. You want to take that equity in their home, leverage it, use it for different options, different opportunities, family situations, gifting, Medicaid. It's just try to keep it open mind. I'm going to go over just a couple of topics, but I'm going to go over toward the end the many things we can do. I do this all up and down the East Coast. I work for a company out of Pittsburgh, Pennsylvania. I'm the National Director of Senior Lending for 38 states, and I'm licensed in 12. So this is all I've done for 17 years. So I want to talk a little bit about if you take a home equity conversion mortgage. That's a legal name for an FHA insured reverse mortgage. So we'll shoot that animal, get that elephant out of the room right away. I want to talk to you a little bit about what we can do. Some of the basics. What is a HECM and its basic requirements? Benefits for home equity and down markets, protecting existing assets. Any of you in here are fiduciaries have not had to make a call and say, well, but the market's done this. It happens all the time. It's going to happen. I've been in the financial realm since '88. And if you'll look at the S&P 500 since 29 to today, it averages about 8%. Up, down, up, down, up, down. So it depends on what side of the market you're on, whether it's up or whether it's down, is the conversation you have with your clients. So use home equity as a buffer asset, a non-correlated asset. Now, the non-correlated asset, this is not tied to the stock market. The growth I'm going to show you is not tied to the stock market, and it's not tied to the appreciation value of the home. I know people say, well, when they get valued houses more, I got more to work with. Not necessarily true. Take your client's assets that you have under management. You can have the proceeds for estate planning, including irrevocable trust, asset protection, and Medicaid trust. I can take a multi-millionaire and get them qualified for Medicaid if it's set up properly through proper trust, estate planning, and how you leverage the money. And we'll hope to have time for question and answer.
How early?
Sir?
How early do you have to start to make that happen?
We're going to be 62 to get qualified for this program. Home equity conversion mortgage. HECM is a mortgage that allows people 62 and over to access some of the equity in their house property and or to purchase a home. You can actually purchase a home as a reverse. Loans don't have to be repaid until the house is sold, they pass away, or they refinance, or they take it out of effect. The only thing they're required to do is to pay taxes, insurance, and any associated fees and things. So if you own a home free and clear, what do you have to pay now? Same thing. The good thing about it is you're not required to make any principal or interest payments as long as one of the borrowers is living in the house as their primary residence. You can't take it, rent it out, and get income out. That's all loan problem. No required monthly payments. We base it on the value, based on the age of the borrower, property value, the product, and the interest rates. Nothing more than cash. It's nothing more than a teeter-totter on money. I've got so much money. I want to borrow so much of it. My life expectancy is 123 months. How much do I have to leave in the house to accumulate the interest over 123 months paying back? Also commonly known as a reverse mortgage, 62 years or older. Common use of reverse mortgage is to pay off an existing mortgage. 40+% of baby boomers are trying to carry a mortgage into retirement. Financial advisors, which they already had it paid for, but if you don't have to make the payment and you can leverage the assets, it's just as good. The non-recourse loan. Non-recourse loan means no one is ever responsible for paying the loan back. This is not a loan against the borrower. It's a loan against the house. The only thing we have to do is make sure that they qualify to be able to pay the property taxes, homeowners insurance, and they show they have the ability to pay that, and they show they have the willingness to do it all the time. Borrower's name always stays on title. We never own the house. We have a lien against the property, just like a regular loan. Has to be paid off. This loan, the balance is going up because you're not making monthly payments. It's increasing your positive monthly cash flow, and we'll talk about other assets as well. Anybody heard anything negative about a reverse mortgage? Come on, raise your hand. Give me about 30 minutes, guys, okay? Same thing, 2008, Cody, in 2008, I got into this business, and one of my former bosses said, why don't you learn to do reverse mortgage? First thing I told him is, I'm not taking advantage of old people. I don't need the money that bad. He said, well, take a look at it. That was in 2008. 2009, I did the first reverse purchase in the state of Virginia, and I've been addicted to it ever since. I've been a hydraulic mechanic. I've been a certified carpenter. I've had my own insurance agency, and I've done mortgages, traditional mortgages, and I do reverse mortgages. I'm a numbers addict. When the numbers get up and they get boring, I look for something else. 17 years, this has never got boring because it changes every day with every client and every need and what we can put together and help them arrange. Have an open mind, please. There is maybe a new option for you. 79 million baby boomers are currently in the United States right now. That was born between 1946 and 1960. Those are qualified as baby boomers. Those prior to those are the greater generation, and there's X's and Z's and everything below. 10,000 a day for the next 15 years are turning 62 a day. Here's a sad story. 1 in 3 have saved $0 other than Social Security to retire. While the other 60% had their houses paid for free and clear, $13 to $18 trillion is set in baby boomers' houses. What's the interest today in baby boomer and reverse mortgage? Anybody seen Tom Selleck on TV? Fonzie, all the others. When I was working with AAG in 2015, they were sending out 50,000 packets a month. People calling in won't know about how to use the equity in their house. So it's only increasing, it's only growing, it's always going to grow because there's only so much assets in the market. Normally we have retirement accounts, Social Security, and pension. I'm going to talk to you about a fourth component today, home equity, supplemental retirement income. Provides tax-free cash. If you go to the bank and you take a HELOC on your house for $10,000, do you pay taxes on it? Borrowed money. You don't pay taxes on borrowed money. This is a loan. We're leveraging the existing assets you have to tap into it for current or future needs. Requires no monthly mortgage payment. When I say mortgage payment, CFPB requires that I state that property taxes, homeowners insurance, condo fees, any associated fees have to be paid. But technically, in my world, it's no principal and interest paid to your mortgage payment. Equity stays in the home, homeowners stay in the house, same time. The worst thing that happened, most people I run into, two things, and we'll go over both of them, I'll go over one of them right now. They'll say, well, you're going to take my mom and dad's house away from me. No, we're not going to take your house away from you. We're going to leverage the equity in it. Since 1988, when FHA came in and insured it, it's called a non-recourse loan because no one is ever responsible for paying a loan. If you go to closing table, you'll see that at closing it says, no one is ever responsible for paying the loan, the heirs, estate, or assets, or whatever. So if the house is upside down by $100,000 when mom and dad move out, nobody's responsible for paying it back. Just what equity is left against the house. And we can show you how to buy the house at the current market value at that time as well. These are a little bit old numbers, but it gives you the ideas. This is about 4 years old, but $6.8 trillion in 401k, 11.8 at this time in home equity, and 12.5. So it's the second largest pool of assets that the clients have to try and supplement their life. But they're thinking, well, I'm gonna lose my house. It costs too much, X, Y, Z. So that's what I try to do, is become an educator. If you haven't heard anything about a reverse mortgage prior to today, it's my fault because I haven't told you. That's my job, to educate individuals who work with seniors, as I prefer to call baby boomers, because I are a senior. So I'm going to be known as a baby boomer. So that's what we're going to talk about. I'll use it back and forth. Sequence returns risk. Got an idea what sequence returns risk? Anybody? Yeah. Okay. All right. So sequence return risk means in order in which good and bad years occur during the distribution stage of financial life and have a powerful impact on how long retirement will last. Any market hurts most when it happens in the first 5 years. So I'm going to show you some hypothetical numbers. Don't worry about the years. Don't worry about the dates. It's hypothetical. It's graphs to show how this can come in and be a buffer asset and help you with your clients when you have those down markets. Sequence return risk. Think of it as a journey in retirement like on a plane flight. The last thing you want to know is you're halfway across the United States or halfway across your retirement, you run out of fuel. So this is a buffer asset. This is something we can step in. This is a spare fuel. Think of it as the way when a fighter jet's in the air and they're on a long mission, tankers come in and fill them up. You got a filling station if you need to use it, okay? Again, don't think about, you're going to see numbers like 1973. Just look at 62 to 91. We're showing a 30-year plan for retirement planning. It's accumulate, the distribution phase is 30 years. Many years, FINRA and a lot of other people have said, use a reverse mortgage as a loan of last resort. And I'm going to show you why it's better to use it the first day you can qualify for it if you have the equity in your house. Okay, so if you take it and we're just showing hypothetical down markets. What we do in a down market here, we're taking and we'll continue to making portfolio withdrawals even in a down market. That runs out in 25.5 years, 25.2 years. Then they say at age 88, do a reverse mortgage. I don't have a crystal ball to tell me what the value of the house is going to be, what the interest rates are going to be, and if they can even qualify for a reverse mortgage. So I'm going to show you some situations where this might not be the best option, but this is just showing 4 down years, red markets into 4 average down years. So with HECM in coordination, with portfolio withdrawals, we're saying for your affluent clients, we're working with people with multi-million-dollar homes every day. We have a program in here that's not FHA insured. At closing, we can lend $4 million income tax free and never has to be paid back. So only the equity in the house. So what we're saying, do if you have a down year, don't take anything out of your portfolio. Pull it out of your line of credit. Let your line of credit pay for it. 2 years, another down year. Second year, don't take anything out of your portfolio. Give it time to recover. Because it's going through enough trouble on the back end, not earning enough to bring in the money. So let's not take it out and sell it off at a loss, because you sell it off at a loss, you're never going to get it back. You don't have enough time to recover. Most people in the market. Again, see what's happening here. So this right here, what we're doing, you'll also notice, I'm going to go back one slide. Portfolio started off at $332,560. Go back to the next slide. Same thing. Look here, guys. What happens at age 86? There's nothing in your portfolio that you're managing. That's bad for the client. Bad for fiduciary. That's their income. That's what they're banking on to help retire. It's for them getting income. So with this one, start off with the same number by giving it rest periods during the time when the market, giving it rest periods when the market's down. Not only does your initial line of portfolio not only does it stay where it's at, it's grown to $1 million $21,282. You tripled your portfolio, usually doing income tax-free money. Client's very happy, family's very happy because you're leaving the portfolio, the client's portfolio to them. And you should be happy because you still got a very good fiduciary money coming in. Compare the two, loan and last resort. At the end of the year, you got zero in the portfolio. Inflation, value of the house, using the 4% appreciation on $495, went to $1,605,000. Same thing here. Cost on the reverse mortgage here, interest deferred and accrued is $471,000. With taking it out in the beginning, it's higher because you took out the interest longer earlier. It's had longer time to accumulate interest. What's the major factor here? You got a $1,021,000 portfolio compared to zero. Take the portfolio, take the 1.6, take this away from it, sell the house, take that away from it. You now have a portfolio and house asset, $2,099,614 compared to $1,134,000. This is not bad, but when you can do this, it's a whole lot better, especially for assets under management. When you take out the sequence of return, if you take them all out and don't make you take anything out of the reverse mortgage, it's going to crash in 25 years. Take out one, you're going to have about $800,000. If you skip one, if you skip the second one, if you pay all three of them, skip all three of them, now here's what your portfolio is. It shows the power of taking assets and completing, supplementing your assets with another asset. We've shown before, right currently is $14+ trillion sitting in baby boomers' house. When I got in the business, it was like somewhere around $4 trillion. Thing about it is the lending power, every time the FHA lending limits goes up, this goes up. So when I got in the reverse mortgage business, the value of the house that we could borrow against was $381,000. Now it's $1,207,000. So the higher the lending limits, the bigger the piece of the pie that you can get. You're not going to get all of it because we've got to leave a percentage of equity in the house to get their money back one time. What does that mean to you guys? Good job. I had those hats, I give it to you. Here is using a line of credit, okay? Show you the simple analysis of using a line of credit. Why it's better to start at an earlier age than it is at a later age. Reverse mortgages are expensive in closing. Compared to what? And I'll get to that in just a second. $19,000 in closing costs. Through 30 years, you now have used this is equity out of your house that you used to close. This is a balance that we've taken out of your house now over 30 years. I don't know what funding, I don't know what you guys get paid to manage people's portfolios, but there's a cost. There's a cost to everything we do to try and help people keep their assets as much as they can. So at this number, out of a $495,000 house, we can lend them $199,000. This is a line of credit sitting there growing right now, currently at about 7.5% annual, compounding annually, income tax free. With a HELOC, you have a downturn in the market, COVID hit. How many banks shut off their lines of credit? How many banks says you had a 10-year line of credit, you have nothing now, start paying me back. It's non-recourse. So the line of credit here was starting off $199. If you never touched it, you never touched this for 30 years, that line of credit is $929,000. Pick up the phone, call them, give them your checking account, and they'll wire that into your checking account, income tax free, anytime you want. Never has to be paid back. It's done correctly through the proper setting up a trust. You transfer this non-taxable equity to the children income tax. over that in just a minute. Value of the house went up. Net equity. So at this point in time, if they took this one, house is worth this, they paid it back, they lost $20,000. Compared to home value 1.6, the net value after paying off the $99,000 is 1.5, but you have an emergency line of credit, buffer asset, non-correlated asset. Whatever the stock market is doing doesn't make any difference. The value of the house doesn't make any difference. Once you get into it, you set up your principal limit factors based on your age and the house value at the time you go. It starts growing regardless of what happens in the economy and regardless of the value of the house. I think this is a pretty good asset, guys.
What is the indexing stat by?
It's CMT, constant maturity treasury. Yeah.
So your only cost in the line of credit is the original setup fee. It's nothing on an ongoing basis.
No, sir. Well, it's $495. It's 0.5% FHA, but that's all built into these numbers. FHA has a funding fee, a fee of 0.5% a year, but that's all built into these numbers. So again, people say, wait till the last resort, wait till you're older, because every year you get older, you get more money. So it makes sense to me to take that money and get it when I need it and don't pay the interest on it. But what you're forgetting about is the compounding factor of the line of credit that's sitting there growing. Numbers a little bit off from what I showed you before, but these are hypothetical numbers showing a scenario. So when you go there at 62, you get 190,000. Would you wait to 72 and take 237,000, or you want to wait to 80 and take out 281,000? That's the way it works. Every year you get older, you get more of the equity in your house because you have less number of years left to accumulate interest. So we can give you more of the equity in your house. Or would you try to take it out 191,000? You're still going to have this compounding factor. Compounding factor is still going to grow inside the product whenever you take it out. But now instead of having 190 in 10 years, you have 317. In 20 years, you have 531. 30 years, you have 887,000. Again, compared to 237,281,000. It's a safety net, guys. It's a safety net. Think of it as a cash value life insurance. It keeps growing. It's there for needs. It's there for needs or emergencies when you need it, but nobody knows at this point in time when you're going to need it. So it's there to provide a safety feature for you. It's FHA insured. About 2% of the children even want their parents' house. One of the things we do with it, we run into with a line of credit. I mean, with the being Medicaid protection, I have a couple of attorneys. Three of the larger attorney firms in the Hampton Roads use me as their professional for reverse mortgage. Come in and put together a portfolio. But the thing about it is, with the line of credit, if you set it up properly, you can put it inside an irrevocable trust. And now not only is your estate protected inside the 5-year look back if you're looking for Medicaid, now your house is protected and you can use, is it better to pay for long-term care with taxable funds or non-taxable funds? Yeah, non-taxable funds, correct. So the thing about this is what we're trying to show you how to do, non-taxable funds. Three loans we did last year, one in Northern Virginia, one here locally. I think the other was in North Carolina, I think, Chris. But the people who have $1 million houses, $500,000 in their portfolio. But guess what? They need in-home care. Anybody want to know what the cost of in-home care is 24 hours a day, 7 days a week today? $20,000 a month. Roughly $20,000 a month. So if you've got $1 million home and you're not using that equity, then you're paying $240,000 a year for somebody to come in and take care of your parents 24 hours a day. It's cheaper to live in a nursing home, but nobody wants to sit in practice in a nursing home. Hedge against home decline. Remember I told you this is a non-recourse loan? Non-recourse loan means if you hear we start off with a good market, 500,000, goes to 530, whoops, COVID hit and everything crashed, down $254,000 in the value of the home. Because it's a non-correlated asset, not tied to the equity in the house, and not tied to the stock market, line of credit just keeps right on checking. So if you were in a situation and you're 70 years of age, I hope that's not me because I just turned 72. I don't want to. But over an 8-year period, if you're here and you go, well, son, I'm dying. I'm going to sell the house. I'm going to pay the difference. I'm going to pay the commissions on the property, and I'm going to sell the house, and I'm going to give you $254,000, say minus 20, $234,000. Here's the house. Well, what if you had the ability to say, call the reverse mortgage company and tell them it's going to be $286,933 paid by checking account. I hand over the keys to HUD and I'll walk away. Income tax-free money compared to after paying commissions on it. Doesn't make any difference, guys. If a house is worth $900,000 and your line of credit is 1.2, take the 1.2 and walk away. You paid an upfront fee for this insurance premium. Income tax-free. I'm going to get a little off base, but if you had a house that you bought for 200 and it's worth 1 million in the line of credit now, if you take the money out and borrow it, you're not paying capital gains taxes on borrowed money. And not only can you sell the house, you don't even have to pay capital gains on it. That was a little off track. Would you rather have a single-use product or a multiple-use product? Single use, one time, go buy the house, we're going to make payments on it, we're going to live there. Oh, I want to refinance. We're going to refinance, lower my payments $20 a month. I had to pay closing costs again. Whoops, I need money for my kids' education. Whoops, I need money to pay the roof on. Whoops, every time you do that, you're paying a new closing cost. Reverse mortgage, you pay one closing cost one time. It is higher, but you have so many more options you can do with that equity in that house and those funds inside that house. And guys, if the housing value goes up, interest rates come down, we could do a HECM to HECM refinance and give you more money. You can refinance the house as well. Some of the things you can do with a reverse mortgage and a HECM. No monthly required payments, supplement income, pay off debt, emergency funds, health care, Medicaid alternatives, in-home care expenses, investment opportunities. People I got a lady in Texas, their house is worth about $2 million. She took out 116, took out about 700,000 in a line of credit, and her and her son flip houses. They take the equity in the house, make a down payment on it, they do repairs, they pay for it, they come back and they pay the income tax on the profit. They put the rest of it right back in the reverse mortgage. It starts growing again. You never have to qualify it ever again once you take it out. Once you get it taken out, it's there. Buy second home, second homes, investment property, purchase downsize, or be closer to a family. Home modifications so you live in better. So delay Social Security. Everybody said, wow, I'd like to take out my Social Security at age 66. But if I wait till 70, I get 132%. Well, just make up the difference with the equity in your house. Or retire at 62 off the equity in your house, wait till 70, and then start taking a full draw on it. It's just a pile of money, guys. 12, 13, 14 trillion dollars in equity. I'm here trying to help you leverage that equity, understand how it can be touched for many, many different options. Play Social Security, tax considerations, IRAs to Roth, conversion to IRAs to Roth. If you've got a $400,000 line of credit and it's growing at 8%, that's 32% growth. You can transfer about $150,000 a year of your IRA into a Roth and let the growth in your house pay the taxes. So you got 100% usage of your. You're not paying taxes on that money. You're paying money, guys. It's just where are you paying it from? Taxable asset or non-taxable asset? People are doing this a lot these days, transferring Roths. Number one, you don't have any more required minimum distribution payments. Number two, under Security Act 2.0, the money you transfer to your kids are now income tax free instead of settling them with taxable income that they weren't expected to get. They may like to have $30,000 from mom and dad every year from a IRA, but some people, if I give my son $30,000 more taxable income, he's going to slap me because he's in a high tax bracket anyway. They just drove him up again. So there's many, many different ways that you can use it. Okay. Estate planning. I do a lot of estate planning. We're one of the only companies in the United States that do that can fund an irrevocable Medicaid asset protection trust with a reverse mortgage. It took us 11 months to figure out between our tax advisors for the reverse mortgage and our tax advisors for the Medicaid. To put it together, we changed 17 words. 17 words. We made your income tax-free money now. Now you can have all that money, all that pool of money, and not pay taxes on it, and it won't keep you from becoming Medicaid qualified. When I did a lady down in Suffolk, she called me. She said she's in wheelchair bound. She's got Monday, Wednesday, and Friday. She's got Medicaid comes in and pays for somebody to come in half a day. Tuesdays and Thursdays she's bedridden because her grandson lives with her, but he has to pay. He has to work. So I gave her $95,000 in a line of credit. Again, if you don't take it out, it's not income. And when you do take it out, it's not income, it's equity. You don't pay tax on it. So what I did for her, she took the same two girls that were taking care of her Monday, Wednesday, and Friday. She hired them personally, and the line of credit's paying for them to come in on Tuesdays and Thursdays. So now she's not bedridden. She didn't have any kids to leave the house to. So we took it and leveraged it for her. And as long as she takes the assets out of the reverse mortgage through the line of credit, as long as she spends that money on her needs, at the end of the month goes below $2,000, it does not affect Medicaid. You can have a $400,000 line of credit, will not affect Medicaid if it's done properly. Great divorce. Anybody heard of great divorce lately? About 40% of baby boomers are getting divorces after their families, after they become empty nesters. So what happens when you come to a portfolio? Right? I need to buy out my wife. I want to take all my estate plan, all my income from me. I want to buy it out so I can buy out the house. Do a reverse mortgage on the house. Give her the equity from the house. You can do an agreement. If it's buying, it will give you 100% of what is available to you the first year, and only take $20,000 out of your portfolio. She can take the money from the reverse mortgage and go buy her a house, $300,000 house with $200,000 down. Realtors love that. They get to sell, 2 more purchases. Give heirs proceeds from your home. A lot of people are taking equity in their home, giving it to their child. To here, 20% down in their home, go buy your first home. Or I want to help my grandchild. I'm putting away $40,000 now, put it in a 529 plan or something of that nature. Something that you can help with. It's just a pile of money, guys. People need to know how to use it and understand what you can do with it and what you can't do with it. Education funds for grandchildren, distribution and state proceeds while they're living, charitable giving, and endorsements. I had a lady who came to me, and her mom said, my mom needs to do a reverse mortgage. I went and talked to her, and she just had the one daughter and 2 grandkids, and she was a big believer in private school. So she was helping pay for the money. She had a sizable estate, but she was still living. She wanted to see the money go to the children, to the private school, so that her kids, her daughter already went through and she didn't give me any money. And now her grandkids going through and she didn't give me money yet. So I talked to her. I said, would you rather wait till you pass away, take this nice plaque, put it on the gym wall, and say, Mrs. Smith donated XYZ of this gym? Or would you rather have it now and give it to them to see your grandkids have the benefits and to use the equity in your home and take care of them? I said, but of course, you might not be around long. Wait a minute, son, I'm 84 and I don't plan on going anywhere. And she said, I ain't liking that plaque thing. So we did a reverse mortgage for her. She took it out. Some people need it, some people don't, but to have a safety net. Like I was talking to Corey a while ago, what's going to happen when it happens? What is your plan B when it happens? If you don't have a plan B, lots of times it's hard to get moving forward at that point in time. Dry air. Many other uses for income tax-free money. This is what I spent 12 months on with a financial advisor, an estate attorney, Medicaid specialist, and most of all, my friend in New York who reviews all trusts that has a reverse mortgage in it. If this doesn't meet your guidelines or your understandings, this is my understandings. I'm not a legal advisor. I'm not setting up your trust for me. This is what's worked in the past. I'm just telling you, if it don't, you say, Mike, that's wrong. Okay, it's wrong. But let's talk about it. Now, maybe I can explain something about where you might have not thought about this in the past. Again, we're going to start off as an asset trust, and we'll convert it to a Medicaid trust once it hits a 5-year. Everything's been there for 5 years. Taxable income. If you have $2 or $3 million sitting up here in the portfolio, you have to creek until 60 months, 5 years, 61 months. You got it protected. Home equity, line of credit proceeds as needed. But we're going to put the house inside the trust as well. Because anybody knows that my understanding again on Medicaid, if you take out a Medicaid, if you say, okay, I'm going to exempt your house. Well, when the guy dies or the mom and dad dies, guess what they want to come back and to try and get to get their money back from Medicaid, the clawback feature. So you put it inside the trust. You set it up through the trustee will do the paperwork for the grantors. You set it up as the beneficiary because the trustee can't pay anything because of the trust guidelines. My understanding, guys, we'll talk about this all you want to if it's something you want to talk about. Live to the heck of beneficiary. So the individuals being paid, grantors has got their money, irrevocable, asset protection trust, or Medicaid trust after the 5-year look back. Grantor. So if you're going down the road and they're going down next, Mike, Corey, you're my grandson and you're my trustee. I think I need a new car to go to the doctor, don't you? You can take the money out of the beneficiary, you take it out and pass it to the grantor as long as it meets the needs of the grantor. New roof, new house. I don't really get a vacation second home in there. So anyway, this is how I've been able to do this, work with many people. Again, there's 3, 4 elder law attorneys in your firms I work with on a consistent basis all the time. So what I want to talk to you about, guys, is do me one favor, please. Take your questions first. Yes.
Does that have any other spouses that do that?
What we call a qualified non-borrowing spouse. You take the 70-year-old and they are the borrower. The 50-year-old is not eligible for a borrower, but as a spouse, they can be used as a non-borrowing spouse, which means we do the loan on the borrower, but the spouse, then we use the life expectancy of the 50-year-old to determine how much money we're going to have. Because she has the ability to live in the house for the rest of her life. It's what's it called, Chris? Deferred into, when you defer it in, when the spouse gets availability to the house.
Oh,
Yeah, anyway.
Yeah.
That one. When a borrower dies, the spouse automatically, under the deferral period, has 90 days to get her name on title. Plus, you can put them on title from day one. It doesn't make any difference as long as they're not the borrower. They're a qualified spouse, so that means they get a house and ability to live in the house after the borrower dies. Negative to that is, if the borrower has a $400,000 line of credit, the qualified borrowing spouse does not have access to monthly payments, term payments, or lines of credit. Now, here's my morbid joke for the day. If you're 80 years old and you got a 60-year-old wife or a 70-year-old wife, and you know you're going to pass away, put a little sign on your chest that says, "Don't unplug me until you empty the line of credit." Because once the line of credit is taken out, he can take it out and transfer it to his wife, income tax free. There's no required minimum distributions on the money. It's income tax free money. No, I mean, there's no probate on it, but you transfer it back and forth. And at that point in time, she gets to live in the house for the rest of her life, only paying taxes, insurance, and HOA, whatever required fees. Any required fees, what you would have in the house to pay for. And again, she is exempt from, if she lives in the house and it's upside down, she moved out, she doesn't have to make anything.
Second scenario,
Yes.
they do this, 20 years down the road,
Mhm.
they decide to live in Brazil.
Okay.
They're selling the house.
Okay.
What happens?
They pay the debt, they pay the original loan amount back plus the interest. Everything goes back to them. We never own the house. It's a loan. They go to Brazil. Heck, once they just take the equity in the house, go live in Brazil 6 months, live over 6 months, they won't have a payment on either one of them. I have a Filipino group that do this. They take the equity out of their house, they go back to the Philippines, they take 50,000 American dollars and 250,000 pesos. They buy a house and pay with in Philippines with the equity from here. They pay for it in cash. They don't have a payment over there. They don't have a payment here, and they rent the house off while they're not there. It's just a pile of money, guys. Big pile of money. So, go ahead, sir.
So, to the basic discussion on timing. Saying the leverage starting now, actually, mostly is thinking that you could get
Yeah.
more. If you do it now, even if you don't need, so maybe a little bigger kind of money then. That's the frame. And the tax rate is pretty. So, talking to me. They're living in a house, you have to get them to say, yeah, this is my house, doesn't work. At the end, most of the uses for the money that do wait. Living expenses, is it discretionary stuff? Estate planning? Yes.
All the above. A lot of people would take, a lot of reason people in their 60s don't take out a Medicare policy, Medicaid, long-term care policy because it's so expensive. So what we do is we show them how to take, working with Corey, you sell life insurance policies. Okay, anyone that sells single premium life insurance policy, single premium long-term care policy. You take $90,000, that buys $90,000 equity of the house, will buy $220,000 in long-term care and $160,000 in life insurance. So you paid it up. Premiums don't go up. If they need the money, they've got the long-term care. If they live there, what happens with your long-term care policy? If you don't use them, you lose them. So this, if you don't use them, you get it back in income tax-free life insurance. So now they've got the money. It's, do they need it? We don't know. It's a safety net, guys. This is used for a safety net on a lot of situations.
Repeat a question.
Yes.
What drives the line of credits increasing in value? What's the underlying factor?
It's a principal limit factor. Like I said, if you start at 62 and you start at 70, is a principal internal growth factor inside. Every year that you get older, you get another piece of the pie. So the thing about it is the difference between the principal limit factor and the debt, the difference between those two lines, what you owe back on the property, the difference between those two lines is automatically a line of credit. Here's the thing about it is, what if you take out, I did a proposal for a lady, she had a $1.8 million house, does not need a reverse mortgage. She said, I ain't paying taxes. I don't want my kids to pay taxes. So what we did is we took and set up a $1.8 million house, she took $40,000 to a little over $200,000 with IRAs. Closing cost is about $30,000. It's 2% of the upfront value of the house for FHA. It's not on the loan amount. It's on the balance. It's on the value of the house because this balance is always going to go up 90% of the time. So I showed her how to do that. She said, Mike, it's $70,000 with closing costs. I said, yep. Well, I don't want that $70,000 to grow. I said, well, what can you afford to pay each month? What do I need to afford to pay each month? So she paid, I think it was $612 a month, took care of the interest. So her balance never went above $70,000. when she got to maturity age of 88, that $314,000 line of credit is now 1.6 million. Phone call away, pay the private checking account inside the trust, leave it to your children, pay up upon death, income tax free money to your kids.
You know, Vic, finance will be there tomorrow.
I don't. FHA insured every dime of this. You got two loans. You got one against Victorian Finance. Sign at closing, you got one lien against Victorian Finance, one against FHA. Everything that Big Fin doesn't do, it's automatically guaranteed 100% by FHA to get their money, that the lender will get their money, and the borrowers will never owe anything. Never responsible. They can have a $5 million life insurance policy and be $300,000 upside down. You don't have to pay it. It's only based on the value of the house and the equities in the house at the time the loan is due. Oh, it didn't absorb all that.
Are any outside factors that determine that increased rate that you talked about in the contract that increases the line of credit? Interest rates outside the company drive that number?
No, technically, what it is, you get if the funds you're taking out 100,000. If we're charging you 7% on that, and I told you 7% growth, deferred interest on that, plus you're going to set the FHA 0.5% FHA, so you get 7.5% on your line of credit. And increase. So whatever it could go down to 3 on what we're charging on the balance, you get 3.5. If it goes to 9, you get 9.5.
So that is driven by outside forces.
Yeah. CMT, concentrated trading. You got a question? Did I say something right about the trust? News trust attorney. Does this sound interesting to anybody? You have in your folder this beautiful picture.
Better in the picture.
I do. Old picture. Plus, my son is a graphic designer, so I can look funny with a beard, without a beard, different hair color. This one will get. It's a survey. Please fill it out. It'll ask what you want to know more about, what you didn't understand, what I could have told you more about, what you don't want to know any more about. Send it in to us, please, because I want to keep my job. And it'd be nice if I could give a little positive input to my owner. And also, we have another one here that is a referral form. You go in, I have a client. Dr. Mrs. X, Mr. Z, house's address is this. It's worth $400,000. They owe $75,000. What they'd like to do is set up a line of credit, or what they'd like to do here, send it to us. We'll take that, send it back to you with a custom design reverse mortgage. If you tell me, Mike, I don't want anything but a line of credit, I went all there. But I could pay off $40,000 credit card debt. Well, that's not what I told the client. So whatever you tell your client is what I'm going to custom design this to do to meet your answers to their problems. Minutes. Yes, sir.
Thanks for the presentation.
Thank you.
So you mentioned the ability to purchase a home this morning.
Mhm.
Can you walk us through mechanically how that would work? And when you may do that versus getting a traditional?
Okay. Working with a lady right now in South Carolina. She's selling her house. She's going to clear $231,000. 63. So right now, interest rates are high. The higher the interest rates, the less of the power we can give you, because we got to defer more of the equity in the house to pay it back. So with that, so she said, Mike, what can I do? So I took it, and she's selling her house. She's going to clear about 250, and she's clearing 231. And she said, but I'd like to have a little bit bigger house. So we did a reverse purchase option. Give a guy with a reverse mortgage, when you take out, when you lend them, when you're doing a refinance, the part you have to leave in the pie that to pay the interest back, that's how much you have to bring on the purchase. So if you have to leave $200,000 in a reverse mortgage refinance for a $300,000 value house, you have to bring $200,000 for a $300,000 house. It's either you're leaving an equity in it to pay back the interest, or you're bringing the equity in. But for her, at $231,000 bought her a $394,000 house. She's going to take the money and pay cash anyway. Now she's got, instead of having to take the 231 and have a loan for another $70,000 or $80,000. She leaves it out of her portfolio. She doesn't have to take a second mortgage out or an additional mortgage. Now she's got the property. Again, all she's paying is taxes, insurance, homeowner association, any dues associated with it. We get a lot of people that are upsizing, downsizing. A lot of people are 27% of the baby that 10,000 a day will move to be closer to family and friends, kids, whatever they want to do. Condos are hot. We have an association with a lot of our investors that we work with, and we can help you get condo complexes approved with the condo association giving us numbers. We can help them get the whole complex approved.